Welcome all to FSA Learning Module 2, the EOCQs on analysing income statements. Under IFRS, income includes increases in economic benefits from increases in liabilities. Well, increases in liabilities don't lead to benefits, so no. B, enhancements of assets. Yes, that would give you income. Not related to owner's contributions. Yeah, contributions are not income. If equity or providers of equity give you cash, they have contributed it. It's not income. So I like B. C, increases in owner's equity related to owner's contributions. No, they are contributions, not C. So the answer is B. Fairplay reported the information shown in Exhibit 1 related to the sale of its products during 2009, which was its first year of business. We have revenue of 1 million and returns of goods sold of 100,000. So it looked like we had revenue of 1 million. If 100,000 came back as returns, we actually had revenue of 900,000. That's what you'd see in the income statement. Cash collected, so cash received from customers, was 800,000. That's what you'd see as cash collected from customers if it was presented using the direct method. And cost of goods sold was 700,000. We deduct that to get down to 200,000 gross profit. What are we asked? Under the accrual basis of accounting, how much net revenue would be reported in the income statement? Well, that's the 900,000. Answer is B. Apex consignment sells items over the internet. Here's a big giveaway for individuals on a consignment basis. So individuals who have stuff, here's some stuff in a box, send it into Apex consignment. They then post it online and people can go online and buy it. Apex receives the items from the owner, lists them for sale on the internet, and receives a 25% commission for any items sold. From that discussion, it looks to me like Apex is not the principal here, does not own the stock, in which case its revenue will equal its commission. Apex collects the full amount from the buyer and pays the net amount after commission to the owner. Unsold items are returned to the owner after 90 days. Further proof that it is not AC's inventory. During 2009, Apex had the following information. Total sales price of items during 2009 on consignment was €2 million. Okay. Total commissions. This is going to be revenue. Retained by Apex during 2009 for these items was €500,000. And we are asked how much revenue should Apex report in its 2009 income statement? 500,000. It is not the principal. Therefore, it only recognizes the commission as revenue. Our company previously expensed the incremental costs of obtaining a contract. All else being equal, adopting the May 2014 IASB and FASB converged accounting standards on revenue recognition makes the company's profitability initially appear, so not long term because these things will come out in the wash, but initially in the year that they change, lower, unchanged, or higher. Well, it can't be lower. Previously, they expensed these incremental costs. Now it's all about matching. If this is a cost of obtaining a contract, that is a cost of generating revenue. And if it's a cost of generating revenue over the life of the contract, then it's going to be capitalized. And if you capitalize instead of expensing, then initially your profitability will look higher. Got to be C. Under IFRS, a loss from the destruction of property in a fire would most likely be classified as A, continuing operations, B, discontinued, or C, other comprehensive income. Well, it's not other comprehensive income. There are a select few things that go in there. Items to do with derivatives hedging, some items from Forex, some from pensions. But the fact that a property was destroyed in a fire does not make it an OCI item, nor is there any suggestion here that it's part of a discontinued operation? Yes, its life was discontinued because it got burned down, but it's not a discontinued operation. That would be part of continuing operations. If it was material, they may disclose it separately, give you more information, but it's definitely part of continuing operations. The answer is A. A company chooses to change an accounting policy. That's fairly big. Change in policy. What immediately jumps into my head is change in policy versus a change in an estimate. If it's a change in an estimate, all you do is adjust going forward. There is no retrospective adjustment. If you change your policy, you must restate. So any prior financial statements you've got in your annual report must be consistent with that policy. This change requires that, if practical, the company restate its financial statements for all prior periods. Well, that's a bit much. Current and future periods, it's got to go backwards a little bit. That's not enough. Goldilocks at C. Prior periods shown in the report, yes. Anything that's in your financial statements. Typically, companies will have 2 columns, this year's and comparables. You will have to restate so all of these numbers are comparable. Answer is C. For 2009, Flamingo Products had net income of 1 million USD. So there's a lot of info here. I'm just going to go and read what we're actually going to be asked to do. What is Flamingo's? Okay, basic EPS. I'm looking for basic EPS. I need net income minus any pref divs divided by my weighted average number of shares outstanding. So that's the information I'm trying to pick out. Flamingo Products had net income of 1 million. So I'm on my way. At the 1st of January 2009, there were 1 million shares outstanding. So that's going to help me get to the weighted average. 1st of Jan, the start of the year. In fact, I'm going to write 1st of Jan so I don't confuse with the date convention. 1st of Jan, there were 1 million shares outstanding. So they were there all year. On the 1st of July 2009, the company issued 100,000 new shares for $20 per share. The price is not going to go in to our EPS count, but it does tell us it was an issue for cash, not a stock dividend or a bonus issue. So we'll weight it as we usually would. 1st of July, 100,000. They were there for 6 months. So my weighted average number of shares, I've got 1 million to start with. 50,000 added in there. 1050 is my weighted average number of shares. The company paid 200,000 in dividends to common shareholders. I only deduct pref divs, so I can ignore that. What is Flamingo's basic EPS? It is the million divided by the 1.05. That should give you 0.952. Closest to C. Company with no debt or convertible securities issued publicly traded common stock 3 times during the current fiscal year. Under both IFRS and US GAAP, the company's A. Basic EPS equals its diluted EPS. It has no debt or convertible securities. So, at the moment, it looks like basic EPS equals diluted. Capital structure is considered complex. Well, no, there's nothing to tell me that its capital structure is complex. Basic EPS is calculated by using a simple average number of shares outstanding. No. It is a weighted average number of shares outstanding, so it's not C. It is A. I've got no information about a complex capital structure. Therefore, I can only conclude that it doesn't have any other instruments. I'm just slightly concerned it didn't tell me anything about options, but if they're not there, I assume they're not there. The answer is A. For a simple capital structure, your basic EPS is equal to your diluted. For its fiscal year end, Sublime Corporation reported net income of 200 million USD and a weighted average of 50 million common shares. So it looks like an EPS, let me just check what we're going to be asked to do. It's diluted EPS. So this time, I'm going to need my basic EPS to check against to see if we have anything that's dilutive. That once again is net income minus any preferred div divided by weighted average number of shares outstanding. But because it's diluted, they're looking for, I'm going to make adjustments. I'll add in to the top any savings I would make as a result of dilutive securities being exercised or converted. And on the bottom, I'll add in the shares that would be issued. That's all the info I'll need. So back to the info. Reported net income of 200 million. So let's start to fill this in. Net income is 200 million. And a weighted average of 50 million common shares. So 50 million to start with here. There are 2 million convertible preferred shares outstanding that pay an annual dividend of $5. 2 million at $5, that's going to be 10 million as a pref div. So that would be deducted if we were calculating basic EPS. That paid an annual div of 5. Each preferred share is convertible into 2 shares of the common stock. 2 million of them. Each gets 2 shares of common stock. So if they were converted, I'd have to add in 4 million shares on the bottom as shares issued. If they were converted, what would be the savings I would make? Savings is the pref div, so I'd add back that 10 million. Now then, got to calculate basic EPS just to check if this is dilutive. So calculating basic EPS is this part here. 200 million less the 10 million pref div over 50 million shares. That's 380. The savings divided by the shares issued, 10 million over 4 million, that is 250. We are saving $2.50 per share on these convertible prefs that are converted in this assumption. Because basic EPS is greater than that 250, that tells you they are dilutive. So we can go ahead and calculate diluted EPS by including that dilutive security. Means we'll have a numerator just equal to net income. Notice if we have convertible prefs as the dilutive instrument, to get to income attributable to common shareholders, you have to deduct the pref div. When they convert, you add it back, so you end up with just net income. Divided by my weighted average plus the shares issued. That's 54 million. Diluted EPS, 3.704, closest to C. Note, and this gives me confidence that we did something right, basic EPS was 380. Diluted EPS was only 370. It was lower, again confirming that these convertible prefs were dilutive. For its fiscal year end, Calvin Water Corporation, CWC, reported net income of 12 million, weighted average shares. So this looks like an EPS calc. What are we going to be asked for? Okay, diluted EPS. So I'll note my requirements here. Basic EPS, net income minus any preferred divs, divided by your weighted average number of shares outstanding. To get to diluted, I would add in to the numerator any savings as a result of conversion or exercise. On the bottom, I'd add in any shares that were issued, but I would only do that for instruments that were dilutive. So let's get back to it. Reported net income of 12 million. So I can start to prepare my basic EPS. Net income is 12 million. And a weighted average of 2 million common shares outstanding, so 2 million here. The company paid 800,000 in preferred dividends, so we can knock those out. And had 100,000 options outstanding. So The potentially dilutive instrument we're looking at here is options. It's options issued by the company, not traded options. So it's not like these are contracts for 100 shares per option. That simply means options over 100,000 shares. Outstanding with an average exercise price of USD 20. Exercise price is 20. CWC's market price over the year averaged 25. Average price, and that's what we should be using, not a year-end price, an average price, 25. Because that average price is greater than the exercise price, that tells you straight away they are dilutive. With the proceeds we get, $20, we cannot buy back all of the shares that we'll have to issue. So they are dilutive. CWC's diluted EPS is closest to, well, there are no savings. We only get savings to add back in the numerator if we have convertible prefs or convertible debt. So all I need to work out here is how many shares are issued. And for options, it's going to be done via the TSM, the Treasury Stock Method. What does that look like? Well, the long way around. We calculate how many shares we would have issued on exercise, 100,000. But with the proceeds, 100,000 in proceeds, times, or 100,000 rather shares, times the exercise price of 20, we're going to get proceeds of 2 million. We will repurchase, or at least the Treasury Stock Method assumes that we will repurchase as many of those shares as we can at the average market price. 2 million divided by 25, we can repurchase 80,000 of those shares. The net increase is only 20,000. Now, you want to do that a bit quicker, you can say, look, there's 100,000 going to be issued, minus 100,000 times the proceeds of 20, divided by average price of 25. To write that a bit quicker, 100,000 into 1 minus 20 over 25. That will get you straight to the 20,000. So that's all we need to add in 20,000 shares to the denominator, because we're not changing the numerator, but we are adding shares to the denominator. It's going to drag basic EPS down. I know for sure it's dilutive, and it should come to 554. 554. It's going to give you B. Lorelli Builders, LB, reported the financial data shown in Exhibit 1 for the year end 31st of December. So a whole world of information. Which statement about the calculation of LB's EPS is most accurate? A, LB's basic EPS is USD 112. We can calculate that. B, LB's diluted EPS is equal to or less than its basic EPS. Well, that is a solid fact. For any company in any situation, diluted EPS is lower if you have dilutive securities. If you have no complex capital structure, it's equal. And if you have anti-dilutive securities, they are ignored and you report diluted equal to basic EPS. That is always true. So without touching a calculator, the answer is B. The weighted average number of shares outstanding is 2.21. Well, factually, this must be wrong and this must be wrong without touching a calculator. But for completeness, let's have a quick look. Basic EPS. Net income is 3.35. Preferred stock divs paid 430. So basic EPS, net income, minus preferred stock dividends, divided by my weighted average number of shares. What do I have? Common shares outstanding at the 1st of January. So they'll be there all year. 2020. Common shares issued as a stock dividend on the 1st of June. You treat those as if they had always existed. If it's an issue for cash, we would weight it according to time. If it's a stock dividend, you go back to the start of the year and presume they were always there. So they're there for the whole year as well. Add those two together. Your weighted average number of shares to use is 2.4 million. As we said, that is wrong. That would give you a basic EPS of 122. A is wrong. Didn't need to do that, but just for completeness. Cell Services, CSI, had 1 million average shares outstanding during all of 2009. This looks like an EPS thing. What am I going to be asked? For purposes of computing diluted EPS, how many shares would be used? So it's just a share calc. 1 million average shares outstanding during all of 2009. So they've given us the weighted average. 1 million. The average stock price of CSI, I've missed out a line, the key line. During 2009, CSA also had 10,000 options outstanding. These are options issued by the company, so they're not contracts for 100 shares. They're just 10,000 options, so on 10,000 shares, with exercise prices of 10 USD each. There's my exercise price. The average stock price of CSI during 2009 was USD 15. That's what we want to use, the average, not the market. 15. Because 15 is higher than the exercise price, that tells you they are dilutive. You cannot use the proceeds you get, $10 per option, to buy back all of those shares at 15. You will end up with a net issue, so they're dilutive. So we will include an extra amount in the number of shares. How many shares would be used? So let's do the calcs. 10,000 options. So we'd issue 10,000 shares. Proceeds. For each of those 10,000 options, we get the exercise price of 10. 100,000. We use those proceeds to repurchase at the average market price. That's the treasury stock method. Use the average market price. They gave us 15. 100,000 over 15. We can repurchase 6,667. We'll have to add in 3,333. If you want to do this calc a little bit quicker, you can. You can just take the 10,000 that we issued into 1 minus the ratio of the exercise price to the average market. That'll tell you we're only going to add in 3,333. So we'll add that to our weighted average number of shares, and we'll get A. When calculating diluted EPS, which of the following securities in the capital structure increases the weighted average number of common shares outstanding without affecting net income available to common shareholders? Stock options. Yes. The answer is A, stock options. When you're adjusting for stock options, there is nothing to adjust in the numerator. They're not getting paid anything at the moment. So we're not reducing net income as a result of having stock options outstanding. So nothing is saved when they exercise. B, convertible debt that is dilutive. That would adjust net income because the minute we're paying interest, we'd have to adjust interest into 1 minus T. Convertible preferred stock. We'd add back the pref div that we're currently paying out. So the answer is A. But which statement is most accurate? A common size income statement. What do we do with a common size income statement? Well, if you have, let's say, revenue of 500, COGS of 200, gross profit of 300, operating expenses of 100, and so on. In a common size income statement, revenue is expressed as 100%, and everything else is expressed as a percentage of that. So COGS would be 40%, gross profit therefore 60%, operating expenses 20%, and so on down the line. What are we asked? Restates each line item of the income statement as a percentage of, no, not net income, revenue, not A, allows an analyst to conduct cross-sectional analysis by removing the effect of company size. Absolutely. If you had another company that made 50,000 revenue, COGS was 20,000, gross profit was 30,000, operating expenses were 10,000, and so on. You can see the point here. Its common size income statement is going to look identical. You can say, look, they run their businesses in exactly the same way. It was just distorted by size. You would look at the two and say, oh, these are completely different businesses. Their COGS is so much larger. No. Their strategy, their business model, if you will, looks very similar. So I like B. C standardizes each line item of the income statement. Yep. But fails to help an analyst identify differences in company strategies. No. That should be and. Helps. That's exactly what it does. So C is wrong. The answer is B.